In this week's video, we'll review the latest charts and data to help us answer the question, will strong economic data force the Fed's hand and spook the stock market? We'll kick off the video reviewing some charts as of month end. Closing prices April 30th. Had a weak session on Friday, but RSP, the equal weight S&P 500 ETF, outperformed TLT by 1.26% for the full week. Late in the session on Friday, around 3:48 p.m., volume on SPY was not particularly high. Probably finished the session somewhere right around average volume. 15-minute chart as of Friday's close, as you can see, haven't even made a discernible lower high on this chart yet. Nothing particularly alarming on these charts either. All of them fairly recently made a new high. All three of the charts are showing some signs of a waning trend. Concerns would increase if we moved into this area here, or this area here. That may happen soon, but it hasn't happened yet. Breadth data as of Thursday's close, using this as one anecdotal example, but it's representative of a wide array of breadth data. Blue and orange lines were the levels that were violated when things began to get a little more dicey in the 2010 correction and the 2004 correction. You can see as of Thursday's close, we're still up in this area here. Things can change quickly, but thus far, these data points are holding up relatively well. Glass half empty, SPY relative to XLP looks a little bit vulnerable within calendar year 2021, but glass half full, what once acted as resistance here, may now act as support. Right now, it looks like we're consolidating above this level here. We'll learn something either way. SP low volatility on the right side of your screen relative to defensive staples. This is what maximum fear looks like here during the COVID plunge. You can see we have consolidation, what looks like a breakout, and now a retest. Once again, we'll learn something in this instance as well. We'll talk about these charts in more detail later in the video. BKLN was basically flat to up during Friday's session, and SPYGLD finished the week up 0.58%. Here are some of the charts on the left side of your screen that we'll be covering as of Thursday's close. No material change during Friday's session relative to the commentary that follows. This is a study that we covered earlier in the year on Friday, March 19th. S&P 500 daily chart dated March 17th, 2021. We did a rate of change study. We were 249 trading days from the March 2020 low at that time. From a rate of change perspective, or relative to the strength of the rally, only two previous times dating back to 1950, 2009, 2010, and 1982, 1983. You may remember, since it's an apex study, when we covered it and had the chart dated March 17th, we said historically we thought the apex would come soon, but we'd have to see when it actually came. Thus, to refresh your memory, what happened in the two previous cases, 1982, 1983, 2009, 2010? You can pause your video player. In the 1983-1985 case, from the quote-unquote date of the signal, the market eventually pushed higher 1.34% and then had a big drawdown after that. Similar outcome 2009-2010, except the rally from the date of the signal was much, much stronger and longer in duration, 8.4%, and then an almost 16% peak to trough drawdown. Thus, in both cases, there was some pain in the not-so-distant future. However, longer term, really, really good things happen, with the market being higher in each case 2 years later all the way out to 10 years later. You can see here, when we originally covered this study, we said it was similar to March 17th. We didn't know when the apex would occur. Now we do know potentially, or have a better handle on it. Now we're looking at an S&P 500 chart dated April 29th. Here's the same 249-day rate of change. And you can see the apex thus far occurred on March 18th. Thus, we can do a little bit more in terms of projections relative to hypotheticals and the historical cases. All of it is shown on the right side of your screen. If something similar occurred in the 2021 case, these hypothetically would be your upside targets, and as you can see, we've already cleared 2 of the 3. Why are there 3? We're looking at the 2010 case, the 1983 case, and the average of the 2. The third hypothetical upside target has not been hit yet. If we were similar to the 2010 case, the S&P 500 hypothetically could end up moving to 42.44 somewhere around May 7th. That's not much higher than the reading on April 29th, which was 42.11, so roughly somewhere in the neighborhood of 30 points or so. And then in each of the historical cases, the drawdown was fairly significant. If we experience something in the present day, red line, blue line, orange line, that's the 2 cases and the average of the 2. Relative to the studies that we've covered in recent weeks and recent months, these hypothetical drawdowns would be deeper than most. We would take out the 2021 low from January of this year. We'd really go all the way back to the September high and into this cluster here. As we all know, this is not a prediction in any shape, form, or fashion. It just helps us with contingency planning. The big takeaways tend to be, after such a strong rally, upside could be somewhat limited, and it wouldn't be shocking to have a big give back. After such a strong rally, upside could be relatively limited relative to the drawdown that could be coming in the weeks and months ahead. We've been hearing a lot about inflation expectations in recent weeks and months. This is Treasury inflation-protected securities in ETF form, TIP relative to standard intermediate-term treasuries in ETF form, IEF. If you know your market history, you know the S&P 500 really started to have somewhat of a sideways consolidation pattern here beginning in 2018. Most assets haven't done particularly well since this point. You can see inflation expectations were falling, hit a low at the COVID low in 2020. Since then, we've exceeded these levels here. This would be your deflationary type look here, where we get a bearish divergence with the S&P 500 before the COVID plunge. Really don't have that in the present day. This would be decreasing inflation expectations, and you can make an argument in the present day on April 29th, we have increasing inflation expectations. That typically would be good for stocks and commodities. However, if we zoom out and look at the rate of change for 279 trading days, as of April 29th, it had been 279 trading days since the March 2020 low in the S&P 500. Once again, we can perform an apex study. The rate of change for this ratio, TIP relative to IEF, in the 2010 case peaked on January 7th, 2010, and thus far, the peak was April 27th of 2021. Thus, it might be helpful to know what happened in the stock market walking forward from January 7th, 2010, which could potentially be similar to April 27th of 2021. Very, very similar analysis to what we just covered. This would be drawdown A, this would be drawdown B. In this case, the January lows hypothetically for 2021 in the S&P 500 would hold. Vaccine Monday high would hold hypothetically, and so would the September high. This seems to align with a higher percentage of the studies that we've done in recent weeks and months in terms of hypothetical drawdowns looking out 1 year. How about hypothetical upside based on how it played out in the 2010 case? If we followed a similar path before peaking and having the large drawdown, the S&P 500 could reach as high as 44.64. And if we followed a similar path in terms of the calendar and the number of trading days or calendar days in the present day as we did in 2010, hypothetically that could occur on July 10th of 2021. Last week we covered leveraged loans and made the argument that this is a more risk-on type slope or look here relative to what we've seen recently. How does this chart look as of Thursday evening? Better, worse, or about the same? You really have to say about the same. Thus, everything we discussed last week still applied as of Thursday's close, or April 29th. This would be somewhat of our defensive bias that we've been talking about in the tape, or economic concern that we've been talking about in recent weeks. This speaks to a shorter term to intermediate term outlook or probabilities until it's cleared. This look here, something that we've covered in the past, it's a monthly chart, speaks to longer term probabilities. Clients and regular viewers may remember back in 2020, we covered this type of chart and this chart specifically numerous times, trying to see if we could get a breakout here. We eventually did get a breakout in Q4 of last year, and if you're a client, this tells us why our exposure to gold relative to stocks has dropped significantly in recent weeks and months. As of Thursday's close, nothing particularly alarming on this chart here. Should the market decide to backtrack, this area here, what once acted as resistance, could act as potential support. SPY versus TLT made a new high relative to the March 23rd low in the S&P 500. Hard to make an argument that on April 29th that this looked concerning. If we flip it around, it can help us understand when treasuries become a little bit more attractive. You can see here in 2020, the ratio TLT to SPY made a higher low here. We're still making a series of lower lows in the present day. The same thing can be said for intermediate term treasuries, IEF relative to SPY as of April 29th. Covered this many times in the past. S&P 500 on the bottom of your screen, NYSE advanced decline line on the top of your screen. Really nothing particularly alarming here yet. If we moved into this area here, it wouldn't be a major crisis, but it would tell us to pay closer attention. You can pause your video player here. This speaks to the percentage of the population vaccinated around the world. Darker is more favorable. Taking another look at stocks relative to long-term treasuries, this looks very complex, but it's relatively easy. These are Bollinger bands here. This is the upper band. This is the lower band. This is the center line. Bollinger band width speaks to the distance between the upper band and the lower band. This is your low volatility, kind of sleepy trend look where my cursor is in each case. We have the low volatility look here. We have it here. The band is low here. The band is low here. And the band is low here relative to the width. You can pause your video player and read this little blurb on the upper left-hand corner of your screen. But it's basically telling us with this close above the upper Bollinger band on Thursday, you can make an argument. We look similar to this point here, and this point here. This is the S&P 500 on the bottom for reference purposes. Right now, from a very short-term perspective, this is telling us to keep an open mind about more upside in stocks relative to bonds. Like anything else, that's a statement based on the chart in front of us, and everything is subject to change. This is as of Thursday's close. Looks very complex. It's relatively easy. You can pause your video player. We know the move off of the 2020 low is similar in many ways to the move off of the 2002 low and the retest in 2003 and the 2009 low into calendar year 2010. This is SPY relative to TLT. This is the ratio. This is the S&P 500 here in the middle box, and this is momentum, daily momentum with Williams percent R. You can see the ratio gets somewhat of a failed breakout look here. Look at momentum. This is a yellow flag right here, and eventually the S&P 500 can't make a new high here, and it continues to fall. Similar situation here. We get what appears to be a bullish breakout and then a failed breakout. Momentum is waving yellow flags here, and this is where the S&P 500 peaks. Nothing particularly magical about any of this. We're just looking for subtle little hints that something may be going wrong or we should pay closer attention in the present day. In both cases, we get a breakout, a failed breakout look, a breakout, a failed breakout look, and a momentum weakness or divergence look on the bottom of the screen. Thus, it might be helpful to know, how does the same chart look in the present day? As of Thursday's close, not that bad. Right now, we have a successful breakout look, and we have momentum looking quite a bit better here in the present day where my cursor is relative to this look right here and this look right here. Like anything else, that's subject to change. As noted on Twitter, obviously, any failed breakouts are violent reversals. Failed breakouts, violent reversals would check pay closer attention boxes. Earlier in the week, we said nothing alarming at this point. That would apply as of the close on April 29th. But as you can see, things can change very, very quickly. Remember earlier in the video we said things began to change for many asset classes in Q1 of 2018? Well, Bitcoin relative to long-term treasuries was a little bit earlier. It was Q4 of 2017 right here. Thus, if this breakout fails here, that would be concerning. This is potential support in here, this high here. So the jury is still out here. We'll learn something if this chart moves in this direction or if it moves sharply in this direction. Credit markets, JNK in the ETF world relative to IEF. It's a daily chart, Thursday's close. If you're a stock market bull, this is the look you want. Consolidation, a breakout in the ratio. Momentum, look where my cursor is. S&P where my cursor is, and then good things happen. Consolidation, a breakout in the ratio. Good momentum, look for the ratio here, and then the S&P 500 in the short term moves higher. You can see the true strength index momentum here, bull cross in November. Remember, good things happened end of October, early November for risk assets. Had a pullback in January of this year. True strength index starts to turn, momentum starts to look better. You can make an argument we have a setup that looks similar on the right side of the chart. However, we do not have the breakout in the ratio yet as of Thursday's close. Like everything else, we'll learn something either way. We're not rooting for this to go in this direction or this direction. What we're rooting for is that we get it right relative to the interpretation and maintaining maximum flexibility. We'll see how it unfolds. We hear a lot, JNK-IEF isn't a good way to monitor the credit markets. There is no perfect way to monitor the credit markets. Thus, we use a weight of the evidence approach. We wouldn't suggest using any ratio or any indicator or any time frame in isolation. Nothing is perfect. So let's check the credit markets from another perspective. Covered this topic many times in the past, so we will move quickly. You can pause your video player. This is the Chicago Fed National Financial Conditions Index. This line here is average credit conditions. If you're above the line, credit conditions are tighter. If you're below the line, access to credit tends to be easier. This is the look of the chart. It's the last data point they released as of April 23rd. There is nothing alarming on this chart yet either. Like anything else, this can move quickly, but hasn't moved yet. Last week we noted that Fed policy relative to the historical cases was a wild card. Why is that? In many of the historical cases, when economic data starts to get stronger and inflation expectations start to rise, the Fed starts to talk about raising interest rates. The Fed starts to talk about having tighter policy or the market starts to anticipate tighter policy and/or the market starts to get concerned about inflation running rampant. In the present day, the Fed has been very, very accommodative thus far. And they have maintained an easy, ultra easy policy stance. You can pause your video player and read this tweet. What could possibly derail some of what we have in the present day? If we get inflation data that's higher than expected, and more likely if we get inflation data that's higher than expected multiple times on multiple reports, and or if interest rates start to rise in a relatively rapid manner again. Because all of that may cause the Fed to start talking about tapering or becoming a little bit more restrictive. And if that's the case, then the probability of getting something like this, or the probability of getting something like this, would increase. And since we all know we do not trade historical studies or historical analogies, we have to see something on the chart in front of us. And that statement is a proxy for the weight of the evidence. The weight of the evidence has to say we're starting to look more like this, or we're starting to look more like this. And as you can see, that may happen soon, and it may happen rapidly. It may happen soon, and things can change rapidly, but it hasn't happened yet as of Thursday's close. I've covered this chart in the past, so we'll move quickly. This is a diversified basket of bonds. Read a riskier basket of bonds relative to long-term treasuries, AGG relative to TLT. We could also look at AGG relative to IEF. Here's the March 2020 low in the S&P 500. So you can see the ratio is moving in this direction. All things being equal, this tends to be a risk-on look. All things being equal, this tends to be some market participants are skeptical. If you look at the right side of the ratio here and we zoom in, this is the same area. We'll learn something either way here. If we're rejected here and we move below this trend line, or if we break out. And we could show you dozens of charts that have a similar look in the present day. You can see here's a false breakout and a sharp reversal. We'll see how this plays out. High beta relative to low volatility. This is the COVID plunge here in the S&P 500 where my cursor is. Ratio here, bearish divergence. Didn't really look anything like that earlier in the year or here, but you can make an argument until this is cleared up where my cursor is here that this does look similar to this point over here in 2020. And until it gets cleared up, we should pay closer attention, which is exactly what we've been doing. Nothing says it won't get cleared up, but it hasn't been cleared up yet. Summary of the big picture after the close on Friday, April 30th. The market remains vulnerable, but the weight of the evidence here, no significant breakdowns yet. We'll continue to take it day by day and trade the chart in front of us. It's extremely important that we don't get stuck on a story or some type of historical analogy. Wake up every day making no assumptions. Next week, we're going to get a lot of economic data. Your drivers, most likely in the coming days and weeks, will be the Fed, economic data, and concerns about inflation. As we all know, the only way any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice. and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.